Investing in the stock market can seem confusing at times, even if you've been investing for a long time, but it doesn't have to be that way, so here are 10 mistakes to avoid. First is not doing enough research. Investing isn't about following the latest trends or blindly trusting stock tips from friends. It's essential to thoroughly understand what you're investing in. This means reading financial statements, looking at balance sheets, understanding the company's business model, and staying updated on market trends. Research helps you make informed decisions and avoid falling for hype stocks or misinformation. Next is lack of diversification. You've probably heard the saying, don't put all your eggs in one basket. And that's especially true when investing. By spreading your investments across different companies, index funds, money market accounts, and keeping some cash on hand, you reduce the risk of one investment tanking your portfolio. Ignoring your risk tolerance is another common mistake. Every investor has a different risk tolerance based on their financial goals, age, and situation. Younger investors can afford to take more risks because they have more time to recover from losses, so they might be invested in companies with higher volatility, while those near retirement might prefer more stable investments like dividend stocks or bonds. If you're constantly worried about your portfolio, it might be a sign that you're taking on more risks than you're comfortable with. It's not worth losing sleep over, so every so often, I adjust my portfolio to match my risk tolerance. Another one is overreacting to market volatility. The stock market goes up and down, sometimes dramatically. Panicking and making quick decisions based on short-term price movements can hurt your portfolio. Volatility is a normal part of investing. Instead of reacting to every dip or spike, focus on the bigger picture and your long-term goals. Staying calm during market volatility can help you remain on track and to avoid costly mistakes. For example, if you would have sold in 2020 because of COVID with the world shutting down, you would have lost over 30% at the March lows. But then the market rallied 70% from there and ended the year up over 20%. Trying to time the market is another risky game that rarely pays off. Even the most experienced investors struggle to predict market movements. This chart shows Wall Street's price predictions for the S&P 500 versus what actually happened. 75% of the time the market was outside of the high to low range from analysts' forecasts. That means that the market's performance was literally outside of the highest or lowest expectation from any analyst. So instead of trying to buy low and sell high, it's better to stick to a consistent investing strategy. Regularly investing a fixed amount known as dollar cost averaging, or DCA for short, can help soften the effects of market volatility and lead to better long-term results. Time in the market is more important than timing the market. This is a very famous quote in the stock market, and it's true. Historical data shows that staying invested over the long term usually yields better returns than trying to jump in and out at the perfect moment. Unless you had been exceptionally lucky with the market timing strategy, you would have likely missed at least a few of the 10 best days in the market, and your returns would have been greatly diminished versus just sticking with the market through all its ups and downs. Another mistake is chasing high returns. These often lead to risky and speculative investments. While it might be tempting to go after the next big thing, like a hyped up stock or cryptocurrency, these investments come with significant risk. Instead of chasing quick profits, it's better to follow an investment plan that matches your financial goals and risk tolerance. High risk can lead to higher returns, but losing a significant portion of your investment can set you back for years. Not rebalancing your portfolio is another mistake to avoid. Over time, the performance of different stocks can cause your portfolio to become unbalanced, increasing your risk exposure. Consistently reviewing and rebalancing your portfolio will ensure that it stays aligned with your investing goals and your risk tolerance. Ignoring fees and costs is another mistake that can affect your investment returns. This can be brokerage fees, management fees, or trading commissions. High fees can significantly reduce your overall returns, especially in the long run. Investing in low-cost index funds or ETFs is a great way to achieve diversification and reduce the impact of fees on your returns. A great low-cost index fund is SPY, which tracks 500 of the largest U.S. companies by market cap. The expense ratio is 0.09%, meaning for every $10,000 you have invested, you pay $9 annually. And this fund is great. I mean, if you literally put $100 into this every week for like 30 years and never touched it again until retirement, I mean, I think you would be a millionaire. Another mistake is letting emotions drive your investment decisions. For example, fear and greed are emotions that can lead to poor choices that are made every day in the stock market, like selling during a market dip out of panic or buying into a bubble out of fear of missing out. Emotional decisions often result in buying high and selling low, which is the opposite of a successful investing strategy. This is why I like dollar cost averaging so much, because it takes the emotion out of investing, since it involves consistently buying at all the highs and all the lows. Finally, not having a clear investing plan is a major mistake. Without a plan, it's easy to make impulsive decisions that can hurt your portfolio. Determine your risk tolerance and time horizon. Create a plan that outlines how you'll achieve these goals and stick to it. This could be investing $100 each week and adjust only when necessary. And a great way to do that is, like I previously mentioned, just to buy ticker symbol SPY. A clear plan should help you during market ups and downs, helping you stay focused on your long-term investing goals. If you found this video helpful, I would appreciate if you like or subscribe. J Money,